Hi, everyone. Thank you so much for joining us today for this year's Pardon the Disruption. My name is Katie Weinberger. I'm an account manager at Refinitiv, and as co-founder of this event and network, I'm excited to welcome back so many of you, as well as extend a gracious welcome to all of our new attendees. Although Pardon the Disruption isn't in person this year, we are thrilled to launch a virtual keynote instead and hope to return to in-person events as soon as it is safe. A few householding items for those of you who are new to this platform. This webcast will be recorded and will be emailed to all registrants within the week. There are a few icons at the bottom I want to direct your attention to. First and foremost is the purple Q&A box. Phoebe and I will be moderating a Q&A session about 10 to 15 minutes at the end of our keynote. So we encourage you to please submit questions during the event, and we will moderate that at the end. And one quick reminder is that this is all screen is enabled through your web browser, so there's not a dial-in. And if you're having any issues with your slides, just refresh your browser. So as a quick introduction, Phoebe and I started Pardon the Disruption to foster an honest dialogue about the tangible and intangible blockers to diversity in our workforce, as well as our corporate cultures, particularly in the financial and technology space. These include socialized homogenizers, like our interests and hobbies outside of work, as well as systemic barriers to advancement, like education, access to mentorship, and more. Our mission is to promote awareness and foster a community dedicated to addressing and championing diversity of gender, race, sexuality, and thought within our industries, which will have an undoubtable positive effect on our businesses and society as a whole. We cannot kick off this year's event without acknowledging and making space for all of the critical work that we as individuals and as an industry have to do in order to dismantle the systemic racism plaguing our society. As white women, Phoebe and I are not experts, but we are working together to educate ourselves and hold each other accountable in our practice. We are committed to listen, to learn, and to do better. We encourage you all to continue your education and your practice in becoming actively anti-racist, and are happy to refer you to a non-exhaustive list of books, websites, experts, and activists whom we follow. At this time, I'd like to hand it over to my colleague, Phoebe O'Rourke, to introduce herself and our keynote speaker.
Hi, everyone, and thanks, Katie. As Katie mentioned, thanks to everyone attending the event today. As a group, we really have great power in making much needed changes in our world, so we thank you all for taking part in the conversation. Today, I have the pleasure of introducing our keynote speaker, Sylvia Kwan, Chief Investment Officer of Ellevest. As a bit of background, Ellevest was founded in 2014 with the realization that gender-neutral money solutions weren't benefiting women. Ellevest began as a digital investing platform that incorporates data-driven decisions around female-specific expectancies, such as pay gaps and longer lifespans. In 2017, it launched private wealth management services that offer bespoke impact investment solutions to women of higher means. And today, Ellevest's expanded offerings include not only investing, but saving, budgeting, learning, planning, and even career coaching. As Ellevest's Chief Investment Officer, Sylvia researches and oversees the investment solutions across both digital and private wealth platforms and develops the algorithms behind the company's investment recommendations. Sylvia has nearly 35 years in the investing industry, received a PhD in engineering economic systems from Stanford University, and she is also a CFA charter holder. Furthermore, she helped build Ellevest from the ground up as the company's CIO. I think we can all agree that that is quite the resume. As a personal fan, follower, and investor in Ellevest, I'm beyond excited that Sylvia is our speaker today. So without further ado, from here, I will pass it over to our keynote speaker, Sylvia Kwan.
Great. Thank you so much, Kate and Phoebe, and to all of you for joining today for the opportunity to share my thoughts on the lack of diversity in financial services, how that has contributed to both gender and racial wealth gaps, and how we can use the collective power of our capital to help close those gaps and create change. For those of you who are not familiar with Ellevest, we are a financial company built by women for women, designed to get more money in the hands of women. So when we, let me pass to the disclosure slides here. When we first started Ellevest more than 5 years ago, people often asked us, why do women need their own financial services firm? Why would you focus your efforts and limit your market opportunity to just half the population? In fact, some people still call women a niche market, which is actually quite odd, since women now outnumber men in the US. Well, as it turns out, women are more than half of the US population. We control 5.1 trillion independently and over 11 trillion jointly, and we generate over 4 trillion of earned income annually. Yet women are underinvested. According to a study by BlackRock, more than 70% of the average US woman's portfolio is held in cash. And BlackRock's most recent survey also revealed that 38% of women invest in the financial markets, and more than half of women believe that investing just isn't for her, that it isn't for people like me. So why is this bad? Well, if women start in the hole with a pay gap, earning 82 cents to every dollar that a man makes, and if women aren't investing the amount that they're earning, and their wealth needs to last, on average, 6 to 8 years longer than a man's, it's really no wonder that women retire with only 2/3 the wealth of men, and they're 80% more likely to be impoverished during retirement. So in a nutshell, women are just not set up for financial success. Now, one of the biggest contributing factors to this, it's what at Ellevest we call the gender investing gap, is that the financial industry was built by men for men, and it hasn't historically served the needs of women well, or for that matter, people of color. And as such, women and people of color have not accessed the kinds of financial services that have benefited men over the years. Well, how bad is it? Well, let's take a guess with our first poll on your screen. What percentage of all assets, and so all assets meaning all mutual funds, private equity funds, hedge funds, and real estate funds, do you think are managed by women or minority-owned firms? Let's take a minute for you to vote. I'll go to the next slide and see how the results are turning out. Great. Well, it looks like 50-50 here, between 10 and 20 and less than 10%. That's actually pretty good. As it turns out, a recent study from the Knight Foundation shows that 99%, yeah, that's really 99%, of the $69 trillion in managed assets are managed by firms owned by white men. That is really a mind-boggling statistic for me. So only 1.3% of assets are managed by firms owned by women or minorities. And yet at the same time, that same study showed that the diverse firms owned by women and minorities were overrepresented among the top performing managers. So it really shouldn't be surprising that 86% of financial advisors are men, 95% of venture capital partners, 90% of Wall Street traders, 95% of mutual fund managers are men. So it's really no wonder that most women feel misunderstood by their financial advisor. Now, we see similar statistics when it comes to racial diversity. Women entrepreneurs received 2.2% of all venture capital dollars, with women of color receiving less than 1%. Over 81% of financial advisors are white, 6% are Black, and only 5% are Latinx. So historically, it's really no mystery why women and people of color haven't been as engaged as we should be with our money, and why they believe that investing isn't for people like me. Women and people of color simply don't see themselves reflected in the financial services industry. And that's why Ellevest was founded, and why it's so critical that we talk about money. Traditionally, women haven't been as comfortable being a part of the money conversation. Women often left investing to dads or spouses. We also don't talk about our salaries, about debt, about saving and investing. We aren't negotiating our salaries like our male counterparts, and we are not investing our earnings. And culturally, it's not how many of us have been brought up. And that has cost us economically to the tune of millions of dollars over the course of a career. Money is really power. Money is power. It is the power to disrupt and change the status quo. So we need to start being part of that conversation. Now, while our mission at Ellevest is to close the gender wealth gap to get more money into the hands of women, it is clear that the wealth disparity in the U.S., as highlighted by the civil unrest that spread across our nation, is not just a gender issue, but one of race as well. So let's take a look at some of the data. So the racial wage gap overall for both men and women is actually worse than the gender pay gap. Black and Latinx workers earn roughly 75 cents to every dollar a white worker earns. And looking at both gender and race, the picture is more grim. Black women earn just 62 cents and Latinas just 54 cents to every dollar a white man earns. So keeping these gaps in mind, let's turn to our next poll. How many years do you think it will take until we close the gender gap for white women, Black women, and Latinx women? Let's take a look. I'm not seeing any results yet, but maybe it takes a minute. Okay, I will skip over. I don't know. I'm not seeing any poll results are here right now. Maybe some of you are, but let's just go straight to the answer. Okay, so to close these gaps, it would take more than a century. That's more than 100 years for Black women and more than 2 centuries for Latinas. Pay gaps are only part of the story, though. The COVID-19 pandemic has painfully exposed the economic inequality that is disproportionately hurting Black and Latinx people. The unemployment rates in May speak for themselves. Unemployment for Latinx people, 17.6%, for Blacks, 16.8%, and for white people, 12.4%. The number of Black-owned businesses in the U.S. is also down more than 40% from February to April due to the pandemic lockdown. In 2018, a study showed that 72% of white households own homes compared to only 41% of Black and 47.5% of Latinx households. Not surprisingly, stock ownership is also predominantly white. 60% of white U.S. households hold stocks, which is double that of Black U.S. households, and 60% of white families also have at least one retirement account, while only 34% of Black families do. So, if you think about it, if you have lower employment, lower earnings on lower employment, lower savings and investing on lower earnings on lower employment, you really don't need to be a math expert to see how this untenable path really compounds and leads to an enormous racial wealth gap. So let's go to our last poll. Let's see if we can get this to work this time. What percentage of wealth do you think the median Black family has relative to the median white family?
And Sylvia, we're just going to hold this one open a little bit longer. Some people were chatting us that they couldn't answer. So I think there's just a lag, but thank you.
Okay, yeah. I sped up the last time, so my bad. Okay. Do you think that's enough time? Shall we move to results? Okay, let's see. Oh, fantastic. That's great. So it looks like most of you are down in the lower percentages, which is exactly correct. I don't have a slide actually that shows the results, but the median Black family in the U.S. has only 1/10, so that's 10% of the wealth of the median white family. And the racial wealth gap is even worse for Black women. The average Black woman only has a penny, so that's 1% for every dollar that the average white man owns. So again, money is power, and that is true not only for women, but for people of color as well. We cannot achieve equality if we don't have economic equality, and we cannot achieve economic equality without gender equality and racial equality. So what can we do to combat structural racism that has led to the widening inequality in our country? So before we talk about what we can do from an investing perspective, I think it's important to understand some of the history of how we got here. It's probably obvious to most of us that our country's history of slavery has set the stage for discrimination. But what's perhaps not as obvious are the government programs that have over the years contributed significantly to systemic racism and economic disparity. After the Great Depression in 1934, there were two federal agencies that were created to increase home ownership in the U.S. and also to protect homeowners from foreclosure. And these were the Federal Housing Administration, the FHA, and the Homeowners Loan Corporation. So the 30-year fixed-rate mortgages that we're so familiar with today originated with these agencies. Now, these agencies developed maps, one that kind of looks like this. This is an example of one from Atlanta. And they developed these maps to categorize neighborhoods by grade from A to D in order of declining desirability and perceived risk. So areas that were categorized as A areas were considered safest, and they're colored in green. B areas that were still desirable were colored in blue. C areas colored in yellow were declining, and areas categorized as D were considered hazardous and colored in red. So neighborhoods with any presence of Black people, even if it was just one family, were generally categorized as red, hence the origins of the term redlining. Now, the results of this practice was that from 1934, when the program was created, to 1968, when redlining was finally banned, non-white households, so minority households, received only 2% of the FHA loans. Hence, many of the Black households missed out on the 30-plus years of home appreciation that occurred during this period. So 50 years later, even though redlining has been banned, this association between race and risk still systemically affects borrowers today. In 2018, even, the city of Sacramento filed a lawsuit against Wells Fargo after finding that Black and Latinx homebuyers were pushed into higher cost loans because of their ethnicity. The GI Bill that Franklin Roosevelt signed into law in 1944 was intended to help veterans achieve social mobility. It provided veterans with affordable home loans, stipends to pay tuition and expenses for higher education and job training. And this benefit created a boom in college enrollment, with over 2 million veterans enrolling. However, because the politicians who administered the program were largely segregationists, Black veterans were denied many of the benefits of the GI Bill. So 28% of white veterans went to college on the bill versus only 12% of Black veterans. And many Black veterans were given only limited options for trade and vocational schools instead of the higher academic institutions. And since they couldn't get a mortgage due to redlining, they couldn't even take advantage of the mortgage loan program provided by the GI Bill. So the GI Bill and the practices of the federal housing agencies helped foster opportunities for white families, but not so much for Black families. So during this time in our country's history, which was important for the growing middle class, Black people missed out on critical wealth creation opportunities through both housing appreciation and higher education that would lay a solid foundation for the future. Of course, when I say Black families and white families, I'm speaking generally. You know, there are many Black families that rose to the top of the economic ladder and many white families who still live in poverty generation after generation. You know, there are many contributing factors to racism and to wealth inequality, both external factors and internal factors. And what I'm talking about here is just one of those factors, an external one that is rooted into our nation's history. So a significant driver of long-term wealth creation for the rising middle class has been home ownership. Before redlining was abolished, both white and Black families could afford to buy homes in suburbs, but Blacks were prohibited from doing so. And once redlining was abolished, however, 34 years later, homes in the suburbs had risen so much in value that Black families couldn't afford to buy them, since they didn't receive the benefit of the price appreciation that occurred in those suburbs. So without a foundation like home equity, a solid education, you can't build financial security, let alone achieve financial parity. So family wealth can take generations to build, and the advantages that are passed down from generation to generation are cumulative. And when I use the word wealth here, I'm not talking about Rockefeller wealth and 1% or even the top 10% kind of wealth. I'm using the term really to refer to really more middle class wealth. So let me give you an example. So let's say your great-grandparents owned a home, and the equity in that home, and probably some amount of wealth, even if it was modest, was likely passed down to your grandparents, which probably meant that the equity that they inherited in the home, with that equity, they were able to afford to pay for college educations, for example, for your parents, without your parents having to incur loads of student debt. And maybe that meant that without the burden of student debt, your parents could save for a down payment for a home, maybe in a nicer neighborhood with good schools, and also save for a comfortable retirement. And then those retirement accounts got passed down to the next generation and so on. So not only does wealth compound, it also provides a financial safety net that is needed for families to survive hardships. Throughout the decades, as the economy has gone through financial recessions, market crashes, high unemployment, pandemics, global financial crises, and so on, it is these families that have had sufficient financial resources to weather them and come out okay on the other side. And because people of color earn less income, have greater unemployment, and end up having a smaller fraction of wealth compared to white households, they have less ability to save, invest, purchase homes, all of those things that can build wealth and financial security over time. So studies have shown that recessions like the Great Financial Crisis in 2008 have a disproportionate impact on minority communities. So if you're on the edge, any kind of unexpected emergency will be a setback. People with lower earnings have a hard time saving, let alone investing. And that difference adds up exponentially, which widens the racial wealth gap. So if we believe, which I do, that the roots of racial inequality today stem from decades of economic inequality that were caused by racial discrimination at the institutional level, that is really where we need to focus our capital and our investments. Together, we can change this. We can intentionally direct our capital to investments in businesses that we believe will work towards fighting racial economic inequality and to an inclusive economy that provides equal opportunities for everyone. And what's interesting and what we all really need to realize is that achieving economic parity, it's not a zero-sum game. Closing racial gaps isn't at the expense of white households. It's additive and potentially exponential to the entire economic pie. So it's not about reallocating slices of the pie, it's about making the pie bigger. In fact, there's some data that shows that closing just the gender pay gap could add $512 billion to our gross domestic product, or GDP. Data collected by McKinsey in 2015 showed that if by 2025, women's participation in the economy, if that participation was fully equal to men's, we would experience a 19% gain in GDP which is equal to $4.3 trillion. Just to put it into perspective, this is larger than the $3 trillion that the federal government has provided so far in stimulus packages this year. So people of color will become the majority of the US population as early as 2045. That's 25 years from now. So not having half of the US population participating fully in our economy doesn't bode well for economic growth. Imagine if we had full participation in the economy from everyone, more earnings, more spending, more innovation that comes with financial stability. Our economy can be stronger and more resilient. And that's good news for everyone. So what does that look like from an investing perspective? Well, let's start at employment and the wage gap. So we can direct our investing dollars towards public companies that have hiring mandates, that have practices that benefit Black people, and companies that provide adequate living wages and healthcare to employees, as well as equitable pay policies and practices across both gender and race. Let's also work within our own companies where we're employed to identify what racial and gender pay gaps exist, and then push our companies to close them. Recently, I think we've seen a number of large, high-profile companies that have pledged to increase both gender and racial representation in management and executive positions. And those are the companies to which we can direct our investing capital. Investing in real estate funds. These are typically most common in the private investment space, but investing in these kinds of funds that focus on affordable housing and workforce housing can help mitigate our housing crisis that we have in the U.S. We can also invest in funds that underwrite mortgages in communities that are predominantly non-white. Access to capital. Providing capital to more Black-owned and minority-owned businesses can also be an avenue to help close the racial wealth gap. So this would include venture funds that are focused on entrepreneurs of color, private loan funds that provide growth financing to small and mid-sized private businesses that are owned or led by people of color. There are also some impact investing platforms that offer fixed income investments that target businesses owned by women of color and also those in low-income communities. So while there are some investing options, namely some publicly traded mutual funds and exchange-traded funds that integrate a social lens in their investment process, there clearly aren't enough. There are a few that specifically focus on gender and women representation, but there's just one exchange-traded fund, one ETF, that has a mandate for minority representation. So as investors, we need to press fund companies to create and offer more mutual funds and more investment offerings that integrate a racial equality lens in addition to the existing environmental, social, and governance lens. Now at Ellevest, in our private wealth practice, we are actively working on creating investment strategies that focus on combating key areas of racial economic inequality. We are currently developing a version of our intentional impact portfolios that focuses on both gender and racial equality. We are also working to develop what we believe to be a first-of-its-kind loan fund with one of our private credit managers that directs capital to private businesses owned or led by women and people of color. We believe that getting more capital directly into the hands of Black-owned businesses and supporting entrepreneurs of color will help grow those businesses, create more jobs, and ultimately strengthen our economy. Now, as we started diving into the data to help us identify practices that have been shown to harm people of color, we found so many areas that go beyond just human rights and workplace diversity. Areas like data privacy, firearms, hazardous waste, predatory lending, and yes, even climate change disproportionately impacts people of color. We are grateful to have a wealth of relevant information from companies like Refinitiv on environmental, social, and governance data, particularly in the area of gender and diversity. So for Ellevest, Refinitiv's data makes it possible for us to identify those companies that are demonstrating how they're positively contributing to the advancement and inclusion of women, and also those companies that through their operations are helping the environment. And this kind of data enables us to craft Ellevest intentional impact portfolios that align with our clients' values. So Katie, maybe I'll turn it over to you to share more.
Great, thank you. I don't know if there's much more to say. And we're always pleased to hear that companies are using our environmental, social, and governance data to form impact investment strategies. Sylvia touched on the disproportionate effect of climate change on traditionally Black and people of color neighborhoods. And there's an emerging term that's known as environmental racism that is meant to encapsulate that disproportionate effect. And our ESG data is helping firms identify which companies have environmentally and socially sustainable policies to help direct capital for companies like Ellevest towards companies which encourage these policies and combat environmental decline and climate change. We also publish a diversity and inclusion index, which ranks over 7,000 companies measured across different metrics for a diverse and inclusive workforce. So if you are interested in learning any more information, I put a hyperlink up here, but you can also just Google Refinitiv ESG data and it will direct you to learn more about how you can incorporate this data as well. And back over to you, Sylvia, for a very exciting announcement from Ellevest's side.
Great. Thanks, Katie. So I wanted to close our time here before opening up for questions with an exciting announcement from Ellevest. Our goal at Ellevest has always been to make investing accessible to people of all backgrounds and means. But even though we don't have a minimum for our digital investing service, we know that we are not reaching many women who are not yet in a position to invest. So I'm excited to share with you today, it was happened coincidentally to land on today, we just launched our Ellevest Money memberships, where women can get access to courses and workshops to get their money and career questions answered, access to tools for saving and investing, and access to financial planning professionals and career coaches. So we want the membership to be a place where women, regardless of where they are financially, can start their money conversation and to rebuild financially if needed. We also wanted them to be able to do so in an affordable way. So we have memberships that start at only $1 a month. We're really, really excited about this offering that we believe will help even the playing field for women and others who have been underserved by the financial industry. So we have a special offer for those of you on the call today. If you use the code Pardon the Disruption, when you sign up, you'll receive 2 months of membership for free. So I hope many of you will take advantage of that. So I realized I've packed a lot into this talk, probably talk a little too fast, but there are 2 things that I'd love for you all to take away in addition to announcing the Ellevest Money membership. So let me bring the money conversation full circle, back to the gender investing gap. So while we have large gaping holes when it comes to both the gender investing gap and racial economic inequality, I see an incredible opportunity today to start closing both. So first, as women, we need to step off the sidelines. We need to be part of the money conversation. If we continue to keep our savings in cash, not only are we not building wealth for ourselves and our families, but we are also not harnessing the power of our capital to help close the gap for others. If we invest with an intention to help dismantle gender and racial inequality, then we are not only helping ourselves, but others as well. Will it happen overnight? Of course not. Systemic racism, gender inequality, those things have been deeply rooted in our country for decades, and it will take a lot of time to change that. But that change, we believe, can start today with all of us if we use the power of our collective capital as a force for good. So thank you so much for hanging in there with me today. I think we can turn it over for any questions that have come up in Q&A.
Perfect. Thank you, Sylvia, so much. We had a few questions come in throughout the presentation. And just to remind everyone, if you have any questions, just put it in the Q&A box. Katie and I have been monitoring it. So the first question we have from Hannah at Bank of America. And she said, you spoke a bit about how Ellevest is making changes to their investment profile given the current environment. But how do you see the overall investment landscape in 5 to 10 years? Do you think we will see more options targeting investments benefiting people of color?
That's a great question. And I'm an optimist. So I'd like to think that absolutely in 5 to 10 years, we will be seeing more options. I think even in the last 5 or 10 years up until now, we've definitely seen a lot more focus on investments that have impact, that have an environmental impact or have governance. And there's a lot. I think one of the silver linings perhaps of the COVID-19 pandemic is that it has totally highlighted lots of eyes are on companies. What are they doing? How are they treating their employees? How are they treating their customers? How are they treating their communities? So there is a lot of attention on this. And I think that's what we have needed. We needed these issues to come to the forefront. And I think we as investors, we're the ones that need to demand these. And I'm seeing a lot more demand. So I think the trend has already started. It's just a matter of, how it pivots and how it focuses. So my expectation absolutely is that we will see, more attention, more investments having this lens going forward in the next five to 10 years.
Great, thank you. The next question is from Jordan at the Outcats Agency, who is asking for any additional resources for investing in companies that are led by Black or Indigenous people of color, or to support closing the racial wage gap. And perhaps you can expand a little bit more and see if there's anything we as investors can do to demand that from companies when we're looking to invest.
Yeah, that's where there's a lot of room for improvement for sure. As we at Ellevest were doing our research and trying to look, what is available out there, honestly, there isn't a lot. I did mention we found only one ETF, the symbol is NACP, that is focused and has that mandate for, I think it's called minority empowerment. And, it's a small fund, out of many, thousands of funds. We definitely need more. We have a few that are gender focused. We have a number that kind of focus on environmental, governance, and social. What is interesting, however, is that, what we found in our research is that a lot of these areas are integrated. And so what is good for the environment is also, because the environment disproportionately impacts people of color, investments that are good for the environment are also helpful in terms of closing that gap. Avoiding firearms, things like that, investments that are around human rights and things like that. So even those investments that may not have the explicit mandate of trying to close racial gaps are better than, I would say, kind of the standard ones. So anything that is sort of focused on social and governance, higher standards in social governance and environmental issues, those are a good place to start. I think, and my hope is we will see more and more investments that are more focused on trying to close the racial inequality gaps. But right now, there's not a lot. So in terms of pressing fund companies, this is where, sending emails, demanding, especially some of the largest fund families out there, the Vanguards and Fidelities and BlackRocks and State Streets, demanding and say, hey, we'd really love to see, you offer a mutual fund or an ETF that is focused on that. We've got a ways to go, but we've got to start somewhere.
Great. Thanks, Sylvia. Go for it.
Sorry, let me, so I do also want to mention that, for most of us who invest using what is publicly available, which is kind of the mutual funds and things like that, we are very much limited to what is out there, which is one of the problems, which is why I'm saying as investors, we need to press fund companies to do better and offering more. On the private side, and this is I'm talking about in our private wealth management area, or there is a lot more opportunity and flexibility to offer investments that are much more targeted. There's lots of reasons for this, having to do with regulations and things like that. Why there is more offerings on that side. Many of them are not liquid and not suitable for the average investor. But I did want to mention that there is opportunity there, and that's some of the things that we're working on also at Ellevest.
All right, perfect. And thank you. The next question is from Kristen at Refinitiv. Despite the fact that redlining is now illegal, many of those lines still exist between neighborhoods. What are some of the ways in which we can mobilize capital to help redraw or even erase those lines?
That's a great question. I don't have a really great answer. I'm trying to think of investments. I mean, one of the problems that we're seeing, right, is a lot of those communities that were previously redlined are, not considered sort of the nicer places to live. And as I kind of think about the kind of, the negative impacts that have grown over the years from redlining, one of the reasons why it's so difficult to sort of get out of those areas is, the economic inequality. And so one idea might be sort of in investment sort of in affordable housing, as a means for, people in those communities to, to have homes that might kind of build those communities and make them more less economically disadvantaged. That may be one area to do that, but it's a great question. I have to think about it a little bit in terms of specifically for the redlining, what we can do about that. Redlining, it occurs, not just only in sort of that geographic, in that housing area, but it also, as I mentioned, many of the banks, have not had a good record in terms of, for providing loans for people of color. Often they have higher rates or they're considered subprime loans and things like that. So there's, I think, a lot of areas that we can touch upon that are not, just the geographic region, but, one of the items might be, avoiding those banks that have those predatory lending practices, and to support, maybe more community banks that are in those areas that are actually, have the fair practices that are treating everybody fairly. That's another thought. It's a great question. I'd love to think about how we can create more investment solutions to correct that.
Great. Yeah, a topic for all of us to think more about. Thank you, Sylvia. Our next question is from Kristen at Hymetric. Kristen says that she also works in the technology industry, which is mainly male-dominated. Have you, Sylvia, faced any challenges in your own career growth, climbing through that ladder personally? Do you have any tips for succeeding as a woman in a demanding and competitive environment surrounded by men?
That can be a topic for a whole nother talk, but thank you for that question. Yeah. Definitely, being in a male-dominated industry has had its disadvantages, but I will also like to say I'd like to think it has had some advantages. And from my perspective, it's kind of the way you look at it. So let me give you some examples. So early in my career, so I started my career in the 80s. I would, for example, go to an investment conference where literally there were like 2 women in a sea of 300 men. And, you're sitting there and you're like, wow, this is like really, I'm one of 2 women here. And so one of the things that I tried to reframe about that picture was, I am one of 2 women here. That means that I stand out, and let me use that to my advantage. That means that anyone that I meet at this conference is going to remember who I am because I'm different. I'm one of 2 women here. And so I try to, instead of feeling, I guess, bad and like, why aren't there more women here? And, oh, I feel really disadvantaged, which all may be true for each of us in our own way. I really try to look at it as like, how can I change the narrative here? And because I found that just changing the narrative, even if I'm talking to myself, actually changes my outlook on what that means to be a woman. So when I realized that I can use that to my advantage. Being unique in the space might mean, maybe my voice is heard in a different way. Maybe sometimes that's good, sometimes that's bad. But I've definitely had some challenge, many challenges that many of you have also experienced on the call. But I would encourage you to see how you can reframe that for yourself and make that into an advantage.
Okay, perfect. And the next question we have is from Taylor at Splunk. And she asks, in today's day and age, social media has gained a massive following and in many situations shows correlation with changes in financial markets. Do you see this becoming more important to pay attention to as investors, particularly while it creates a platform for minority populations to be heard?
Can you repeat the first part of that question, Phoebe?
Yep. So in today's day and age, social media has gained a massive following and in many situations shows correlation with changes in financial markets. I'll just repeat the whole thing. Do you see this becoming more important to pay attention to as investors, and particularly while it creates a platform for minority populations to be heard?
That is really a great question. And I will say that one of the most surprising things in my time at Ellevest is social media. If you kind of think about financial services, nobody gets very excited about opening up a brokerage account. No one says, oh, wow, I'm so excited. People get excited about, products and services and things like that, but they don't really get excited about financial services. And I think at Ellevest, we've been able to use social media to make the same kinds of emotional connections that happens outside of financial services. So I think that especially for women and people who have been underserved by financial services, I think the use of social media can help include more people in the conversation and be more engaging for people in the conversation. So I view social media as really, really powerful in in financial services to help engage more women, especially because it helps build community. And I think one of the big holes that we've had as women, is because we're not being, we're not talking about money to each other, is building these communities through social media so that we can have those conversations and we can start talking about it, because that's really where things start. You can't just kind of go from 0 to 10. You have to start somewhere. And I think starting small, building community, using social media, I think is a really, really important and huge, huge advantage, I think, for financial services if they can harness the power of social media to do that.
Great, thank you. It brings how conscious we all need to be of our use of our social media platforms as well. So the next question is from Kristen at Refinitiv. She shares, Goldman Sachs recently announced that they will not do an IPO for any company that has an all-white male board. How can we make this an industry-wide pledge and even start to extend it toward cutting off lines of credit to those same companies and firms?
Yeah, I think that's movement in the right direction, and we do see a lot of that. We see mandates from states. I think California is one of them, that mandates that all, certain companies need to have at least, one woman on the board. So I think, we are certainly moving in that direction. The more pressure that we can put on these firms, whether that's, through activism or whether that's through using our capital. So, for example, some of the strategies that we offer here, are investing in those companies that do have the, not only the diverse boards, because that's just really, really where it starts, but there's so much more about women in the workplace, women in management, women employees, looking at pay policies and flexible work schedules and daycare and things like that. So it's not just limited to women on boards, but certainly is inclusive of that. So I think that the trend and having a company like Goldman make that kind of a pledge is huge, because that's just going to hopefully pressure more companies to do the same. So I think we're going to see more and more of that. And if that's what it takes to kind of, those kinds of mandates and those kinds of pledges, if that's what it takes, then that's certainly a move in the right direction.
Yeah, I agree. I actually remember the day that press release came out, and I remember it was a big day. So it's always a good thing. And then next question we have from Sarah at Refinitiv. Will focusing on more socially responsible and sustainable investments yield similar results to traditional investment strategies?
Great question. So at Ellevest, we believe that there is not a trade-off in terms of performance between doing well and also financial or investment performance. We strongly believe that you can have both. And that's really based on the research and the data that actually shows that investing in companies with kind of higher environmental, higher social, higher governance standards actually perform better and have better financial performance. I think there's a lot of data that shows that diverse teams make better decision-making, make better decisions. There's also research that shows that having more women helps actually mitigate risk. They're kind of more, they're more cognizant of risk, and so they manage better for downside risk. And so all of the data so far really shows that not only can you get competitive performance, in many cases, the performance can actually be better at lower risk levels. So we get this question a lot, like, do I have to give up returns, to do good with my money? We strongly believe that you don't. And especially, we've come a long ways. I think that was true at one point, probably, 20 years ago. I think that was true. But the game has changed. I think there's so much more opportunity for impact, and a lot of opportunity to really do well from an investments perspective and have those returns, and at the same time invest for good.
Okay, perfect, Sylvia. I think we're going to wrap it up with Q&A for now, but I just wanted to thank you and to let everyone know that Sylvia has graciously offered. If you want to get in contact with Katie and I, if you have further questions, just let us know, and she would be willing to answer those communicated through us. But we just wanted to give a thank you to everyone, especially Sylvia today. It was a great conversation, and as always, you can follow up with Katie and I. We have a LinkedIn group, Pardon the Disruption. You can follow us on Instagram, as we were talking about social media communication, fits in perfectly. And then we're also just available via our emails. So firstname.lastname@refinitiv.com. So just want to thank everyone again. And follow up if you have any questions, but hope everyone has a great rest of the day. And thank you.